Right now, BTC is hovering near $70, $800 on Binance. On the tiny time frames, it's basically flat, and that's exactly why your instincts are about to betray you if you're not careful. You might also see price differences across exchanges in real time. Binance Spot can print a few $100s away from Coinbase during fast moves. For structure, I'm focusing on one primary chart. Over the last 4 hours, Bitcoin is down roughly 0.25%. The high tagged about 71,614, the low wicked near 70,655, and now we're drifting in the middle of that range. That range sounds boring. It isn't. Choppy ranges are where accounts get siphoned because you're tempted to keep clicking, keep fixing the trade, and the market keeps flipping you. In 20 seconds, I'll show you the one line everyone ignores that decides whether this turns into a squeeze higher or a trapdoor flush lower. Don't blink, because this is a level game. Quick note, naturally, this is educational only, not financial advice. I'm not telling you to buy or sell Bitcoin. I'm showing you how to read what the market is signaling right now. Stop. Look at this. In the last hour, liquidations were wildly one-sided, about 10.05 malers of shorts versus roughly 0.92 malers of longs. That's shorts getting crushed, not balanced trading. Over the last 4 hours, it's similar. About 12.0 manon shorts liquidated versus about 3.99 malers longs. If shorts are being squeezed, you'd expect BTC to rip. But it didn't. That's your curiosity gap. When shorts get squeezed and price doesn't trend, it often means the buying pressure is being absorbed. Someone is quietly taking the other side, stealth style. Liquidations are a thermometer, not a crystal ball. They tell you where traders were leaning and where forced exits happened. Used right, they help you spot crowded positioning and looming pain. Now add the second clue, spot volume. The last 4 hours of spot quote volume are roughly 169.8, which is only about 59% of the 24-hour baseline pace. Participation is thin. When spot volume is quiet, the order book can feel thinner than it looks. That's how you get sudden wicks that seem random. They're not random, they're stops harvested in a vacuum. Thin participation is where liquidity vacuums happen. Fewer real bids and offers means price can move farther on less force. You don't need a whale, you just need an empty hallway. Third clue, futures positioning. Binance open interest is still heavy, around 86,462 BTC, roughly a $6 billion ballpark. That's a lot of leverage sitting there, waiting to be triggered. High open interest can sit there for hours, then unwind in minutes. That unwind is the cascade. One side gets squeezed, the other panics, and price accelerates because forced orders hit together. Funding is basically neutral, around +0.006% per 8 hours, and the 7-day average is slightly negative, around 0.0114%. That tells you neither side feels overheated yet. Neutral funding sounds safe. It's not. It means both bulls and bears feel comfortable, and when both sides are comfortable, the market can choose the most painful direction suddenly. Here's the metaphor. This is musical chairs. Open interest is the number of people in the room. Low spot volume is the number of chairs. When the music stops, someone hits the floor. Let's map the box. Ceiling, about 71,614 is the 4-hour high. Floor, about 70,655, the 4-hour low. Magnet, about $70,500, the 24-hour low that attracts stops and bids. The edges of the box matter because that's where real decisions happen. In the middle, you're guessing. At the edge, you're testing acceptance. Does price stay, or does it snap back fast? This is where people donate money. They trade the middle of the range, they add leverage, and they assume a bounce will repeat. Then price sweeps the same line and the cascade starts. Here's what just happened, step by step. First, BTC pushed up into the 71.6K area and breakout buyers piled in. That's when the crowd starts chanting, "It's confirmed." Second, price rejected and slid down towards 70,655. That's the flush. Stops get triggered, emotions spike, and late longs get trapped because they bought the top of the move. Third, instead of trending, Bitcoin went quiet. Small candles, slow drift. That's the psychological trap because boredom makes you overtrade and chop makes your P&L bleed quietly. In a minute, I'll show you the tell that separates a real break from a fake one. It's not your favorite indicator. It's speed, volume, and where the wicks land. Picture this. It's 2:14 p.m. Eastern. You refresh the publicly posted ETF flow board for March 18th, and EBIT still shows about 103.8 MEDSM. Everyone panics, yet Bitcoin barely budges. That's a war story moment because headlines scream outflows, but the tape stays stubborn. Sometimes that's weakness. Sometimes that's absorption. The trick is not guessing, but mapping. Now zoom out to the US backdrop. Stocks were red, SPY down about 1.38%, and QQQ down about 1.42%, while the dollar proxy was green. Risk-off pressure was lurking in the background. If you're watching from the US, pay attention to when liquidity shifts around the equity open and close. Those windows can turn a slow range into a fast move, especially on low spot volume. And remember, spot ETF flow data usually lags by a trading day. The flow numbers we're referencing are dated March 18th. not just now. Don't let anyone sell you fake urgency. All right, present moment. BTC is reacting inside the lower half of the box. If price keeps tapping 70,655s and popping, traders start calling it support. That word can get you trapped. Support in a range is not a promise. It's a location. If $70,655 breaks with speed, the market often vacuums into the next pool, and that next pool is around $7,500. If BTC holds $70,655, reclaims $71,000 and grinds back to the ceiling, bulls have a shot. A clean break and hold above $71,614 is where a squeeze can actually run. If BTC loses $76.55 cleanly and snaps down fast, expect a quick flush toward $7,500. If $7,500 doesn't catch it, round numbers like $70,000 often become the next magnets, and the nastiest path is the fake reclaim. BTC briefly reclaims above $71,614, squeezes shorts again, then slams back into the range. That bull trap wick is how both sides get squeezed. Here's the trap. Breakouts in low-volume environments can be weaponized. A tiny push can trigger stops, force liquidations, and create a temporary pump that looks real until it reverses. So how do you tell? Watch the character of the move. Real breaks show expansion, stronger volume, faster follow-through, and fewer immediate wicks. Fake breaks show spikes, then rejection. A clean breakout is about acceptance. Price has to live above the level, not just touch it. If it only tags the line and instantly rejects, that's often a stop run, not conviction. In 30 seconds, I'll give you a filter. If price breaks a level but can't hold it for more than 3 5-minute closes, it's a liquidity sweep, not a trend. Set alerts instead of staring at every 1-minute candle. Alerts at $71,614, $71,076.55, and $7,500 keep you objective. The goal is to react, not to get hypnotized. Also watch liquidation skew. When shorts are being obliterated and price still can't climb, it can hint at distribution overhead. That's the market quietly selling into forced buying. Open interest is the fuel. High OI means more potential energy. But fuel doesn't tell direction, it tells volatility risk. That's why you can get a violent move either way from here. Neutral funding is the calm mask. It says the crowd isn't paying up to be long. That can be constructive later, but right now it mostly means both sides can get trapped. Here's where US timing matters. When liquidity shifts from Asia and Europe into the US session, that transition can amplify moves. Thin spots plus heavy leverage is where wicks get nasty. And when stocks are bleeding, Bitcoin often gets dragged, even if the chart looks independent. Correlation isn't perfect, but in risk-off waves, BTC can get engulfed by the macro tape. Now, let's talk psychology. Most people get chopped here because they need certainty. They want one answer, up or down. But markets don't reward certainty. They reward adaptation. If you trade the middle, you're trading noise. Noise is designed to steal your attention and your stops. The edges matter, $71,614 above and $70,055 below. Everything else is temptation. If you miss the last push, don't chase the next wick. Chasing is how you buy the top of a squeeze and sell the bottom of a flush. Let the market show its hand. In 20 seconds, I'll show you the exact tell candle that screams trapdoor. It's the one where we break 70,655, bounce, then immediately lose it again. That's when the flush accelerates. Another tell, the reclaim failure. If BTC pokes above 71,614ers and then closes back below it quickly, that's often a signal the breakout buyers just got trapped. That wick is a receipt. This isn't about being bearish or bullish. It's about being honest. In a box like this, both sides can be right on direction eventually and still get obliterated on timing today. Real risk note, because it matters. Leverage turns a normal range into a landmine. If you're using leverage here, size down. Volatility can spike without warning in a liquidity vacuum. If you took a loss today, respect it and reset. Ranges are designed to grind you down emotionally. A quick break, a short walk, and a plan beats revenge trading the same level twice. Let's connect the liquidation data again. Last hour, roughly 10.05 Maller shorts versus 0.92 Maller longs. That means bears already took pain, and yet price didn't explode upward. Interesting, sometimes that's bullish absorption. Buyers are taking everything offered quietly. Other times it's bearish distribution. Sellers are feeding the squeeze, letting shorts liquidate, then fading. So what do we watch next? We watch whether $71,000 becomes a springboard or a ceiling. If BTC can't hold above $71,000 on reclaim attempts, the ceiling pressure is still winning. And we watch whether 76.55 gets defended with strength or just with weak bounces. Weak bounces are red flags. They're the rubber band stretching before it snaps. Rubber band markets look sleepy, then they move like a slammed door. You don't want to be the person chasing the door, you want to be the person watching the hinge. Here's a quick mindset reset. Your job is not to predict the next candle. Your job is to define what must be true for each scenario, then act only when the tape confirms. In 15 seconds, I'll give you 2 confirmation signals that make a breakout worth respecting. One is volume behavior. The other is how fast price returns to the level after the break. Signal 1. Expansion volume on the break, not after it. If volume only spikes after the move, you might be seeing late chasers, which is often when reversals begin. Signal 2. Retest behavior. A real breakout breaks, pulls back, and holds the level like a floor. A fake breakout breaks, pulls back, and dumps through the level like it never mattered. Now the bearish pathway clearly breaks 70,655s with speed, and you can get a stop cascade into $7,500. If $7,500 cracks, the vacuum can pull towards $70,000 fast. Now the bullish pathway clearly holds 70,655, reclaim $71,000, then break 71,614s and stay above. If that happens, shorts can get squeezed again, and this time momentum can stick. Notice what I'm not doing. I'm not promising a pump. I'm not calling a top. I'm giving you a map so you don't react like others when candles turn ugly. Here's the third path. Extended chop. BTC can keep oscillating, draining your patience. That's why the best traders often do less. Chop is designed to make you overconfident, then punish you. The best trade in a liquidity vacuum is often no trade until the edge breaks. Patience feels boring, but it keeps you from getting trapped in the chop where fees and mistakes slowly devour you. If you feel the urge to make something happen, that's your cue to step back mentally. The market doesn't care about your schedule. It only cares about liquidity, leverage, and emotion. Let's anchor back to the opening hook. Shorts got devoured, yet price barely moved. That tells you the easy trade is gone. The next move will try to trap late chasers, and this is why I said it's not calm. Calm is stable participation. This is low volume, high open interest, and one-sided liquidation pain. That cocktail can turn violent with one push. In a moment, I'll tell you the worst place to enter in this setup. It's not a price, it's a feeling. The relief after a small bounce that makes you reckless. Relief bounces are how traders get trapped. You see green, you think danger is over, you jump in, and then the market rolls over again. That second push is where accounts get flushed. So if you're watching right now, pick your line. Are you watching 71,604 as the ceiling or $70,500 as the magnet below? Drop one number in the comments. No explanations needed. And if you want my lean, here it is. I respect the box, and I refuse to trade the middle. I want confirmation at the edges. Anything else is just noise dressed up as opportunity. Watch next. If we break and hold above $71,614, I'll cover the squeeze pathway and next resistance. If we lose $70,655, I'll cover the flush pathway and trap signals. Final reminder, naturally and briefly, this is educational only, not financial advice. Bitcoin is volatile, and nothing here is a guarantee. Treat it like a map, not a command. One last thing, when the move finally happens, it will feel obvious in hindsight. That's fine. Your job is to survive the uncertainty, so you're still here to participate when the clarity arrives. All right, your move. Comment 71.6 if you think the ceiling breaks, or 70.5 if you think the magnet wins. Then watch the next video because this range won't last forever.